We can also throw on our resistance levels here. A while back we saw this Dell chart, and we noticed how it got above the high of the low bar, backed off, it got above the 45. But now we want to project a few targets. So we can take our first high here, divide by our low, and this will give us a resistance level. So there's one here, and it goes all the way up, and it does stop at all the resistance levels all the way. So these are minor points to think about re-entering a trade. If we got stopped out on some kind of angle we were using here, we would want to think about re-entering down in here. If we took a profit up here, maybe we'd re-enter on here on the trend line. But we also want to know is, well, where really can this thing go? I don't just want to know the minor support and resistance. What's the major picture? Well, we need more perspective rather than just do this little tiny decline in here. We need to see some real perspective. So we go back to the last major swing. Now I've blown up back quite a few months back, and we find out from this last top and collapse, I put on normal retracements of 25%. And we find out that the first major target up was 25% of the range. And ultimately, this major run came back to the 50%. So it really boils down to, although this looks very confusing at times with many little highs and lows, the big scheme of things is you had a 25% retracement of a giant bear market leg down. You got to the 50% retracement of the big leg down, and then it started to come unglued. So although we may have support and resistance numbers all the way up for very precise work, in the big scheme of things, it does have a tendency to gravitate to these 50% levels. And we can even go back farther than that. If we want a bigger perspective, we'll go to the weekly chart. And now we find out we've been in a 4-year bear market. There's a year, 2, 3, 4 years down. If I put on some angles here, this was a 4x1, and here's the 1x1 bear market angle. The first initial buy signal on the weekly chart was the high of the low bar down in here, and it regained the prior low. Somewhere in here, we'd be getting long. It also broke a trend line coming down, so we'd be long somewhere down in here because the pattern has changed now. On a weekly basis, we're making higher highs and higher lows. We're above the signal reversal bar. We had an angle that we're breaking out of. You could have put a secret angle on here too and subdivided it. But in the big scheme of things, we can say, okay, at a minimum, we'll probably retrace 25% and maybe 50%. And by the time we get to 25%, we find out it intersects our 1x1 angle. Indeed, that serves as a magnet to suck these prices up. And then they're respecting them. As they break out here again, we're long again, looking at least here. And if we get through there, we're hoping they're going to go all the way here. In this case, it failed again, so we don't know. But if it was to cross this 1651 again, it almost certainly would go up towards $25 and beyond. So we see from this, by getting a bigger perspective, we can get added information. We can use this in a number of ways. If we take the last bear market swing and subdivide it into at least quarters and halves, we often will find that these are the normal measured moves that we come up with a lot. For instance, here's the distance between the half and a quarter movement. It's basically a 1/4 length of the leg down. And if we place that colored marker here over here, we find out it's pretty close to our measured moves that we've observed. So sometimes if we just take that last big leg down, we will find out that many of the legs on the way back up, even though they're displaced a little bit, are those same 25% movements. Now, after we get some idea of what the really big picture is, we have to have a strategy of what kind of trader we're going to be. Are we going to swing trade for long periods of time, or are we just going to scalp every day and intraday? Most people like to scalp. This is the hardest thing there is to do, is scalping. And so there's a lot of little gimmicks you want to watch for when you're scalping, whether it's S&Ps on a 5-minute, 15-minute hourly chart, or even trading IBM every day on a daily bar chart. And most of the gimmicky trades evolve around the bar overlap method. On a daily bar, there is an average measured move basically every day. and you find out by observation what is the average day's movement. And you can throw on an angle like a steep 4x1 angle, 75 degree, and put a couple of these bars on. And you can see, because of the mathematics of a steep angle advance, and these are the ones you want to trade, what would be your average overlap and how much would each bar pull back towards the preceding day. They'll at least pull back to the midpoint and maybe the 5/8 point. So they'll overlap a certain amount every day, and that's due to this. So on the overlap method, we would have a strategy basically every day. Whether it's a bull trend or a bear trend, it doesn't necessarily matter. And this is where it gets very dangerous unless you're a professional trader and you know what you're doing. As I've emphasized earlier, you really only want to buy the dips in a bull market. So if you're up one day, you would wait for the overlap to approach the midpoint or the 5/8 point of the prior day, then you would go long, and then it would turn back up again the next day or so. But you can also, if there's a big up opening and it opens up about your overlap distance, you can often day trade short here, let's say at 10 a.m. in the morning, knowing that there is almost always a regression towards the mean, and sometime during the day they'll pull back, and they may actually go down on the day under yesterday's close, scare everybody out, and then you'll cover your short right here. So there is this regression towards the mean every day. The only time you run a risk of shorting the overlap is if it's a bar that's just going to gap and run. And in those cases, you have to be keenly aware of the momentum on the tape. If it's an everyday event and you're looking at the Dow Jones 30 and you find out that half of them are up and half are down and the biggest one is only up $1 and there's one down $1, then it's a normal everyday, and the normal everyday overlap can be shorted. But if you find out they open up here and every single stock is up $1 to $2, it's probably going to be a blowaway, and you have to cover that short immediately and get long it, because it's going to be no overlap whatsoever. The same size bar is going to be here, but it's going to be straight up. So these are the overlaps. You can also determine overlaps in a practical sense this way. Here's a weekly chart of Caterpillar. Take your draw line tool and just draw a copy of the previous day's bar. And that's what this red one is here. And then take it and drag it down and attach it to the middle of the bar. First, you have to make an assumption, are you going up or down? But in this case, we're going down. So I attached it to the center of the bar and down. And this will be a representative forecast of what our next day should look like. So this next day's bar here is forecasted by taking the previous day's size bar and attaching it to the center point and dragging it here. And we see we did capture probably 5/8 of the next day's activity. So the idea being is anytime they're within this purple range, if they opened up, we could go short. If they got down in this area, we would cover a short. And then the same thing. The next day, we take another length of that bar, we attach it. Another day, we attach it. Some days when they go into a flat, it doesn't work, but many times this overlap would work. Also note over here, I've just put some parallels on the chart, connecting the highs, connecting the lows, and we can see quite clearly this idea of regression to the mean. From a bar one day here, the following day it's higher, but it also regresses almost to the center of the previous day. And then after this day, it's also a point during that day where it will be at the middle of yesterday and higher. And then the next day was an outside day. It went both lower and higher, but it did regress to the middle. The next day here, it certainly regressed to the middle of that bar. This was a little bit stronger, didn't quite regress to the middle. This one certainly went through the middle. So what I'm basically saying here is don't be in a rush to do anything. If they open up one day and you want to be a buyer, don't chase them to buy in at 10 a.m. on an up opening after a big up day the day before. They will invariably top out, and by 10:30 or maybe even 11 o'clock, they could be down on the day under yesterday's close and be right at the ideal buy point. So you want to factor this in as a strategy of where you're going to buy some of these things. Now, these strategies are set up in the morning before the market even opens. So you want to make a couple of estimates. So let's assume that this is the current day at the close. We don't know this information yet over here. This is the next day, and so far we don't know. But what we do know is we know the low yesterday. This was the prior day. This was the low on a 15-minute chart. And the high yesterday, 1203. So we know the range was 15 S&P points. We can also calculate the midpoint, which is right here, and we'll project that out into the next day. And if we do a conservative overlap, say the bar is only a quarter, but many times that we've seen it might be a third or so. 1/4 of the range of the preceding day, 0.25 times that, is 375. So we could subtract that from the low. So if they went down on the day, they might overlap yesterday's low, and we get 1184. So this would be our estimate of what might happen, and indeed, that's exactly what happened. On the upside, we do the same thing. We make an estimate of our overlap, add it to yesterday's high, and we see we didn't quite close at the high. We pulled back and closed right here. Well, the next day, we gap open, we pull back, and we go up for a couple of hours, and we exceed yesterday's high, but we get into the overlap territory. Now, maybe this was not a quarter, maybe this high spike here was even a third. But now we're in the traditional overlap, and there will be a tendency to regress to the mean. So if there's not tremendous momentum, where there's going to be a giant up bar, usually at the overlap from yesterday's high, we're going to fail. And if at the same time we have a trend line coming up here, and we find ourselves dipping back under the overlap measurement, then we definitely want to go short. And so we're looking for a signal reversal bar. You could look at the high of the low bar over here, which wasn't violated here, or the last little tiny rally low of the high bar. And once that's violated, we go short. And it's also under a trend line we can use as a protective stop. And we know it's going to pull back towards the midpoint of yesterday. And here's the people waiting to cover on that midpoint. Rallies up, fails at the early morning resistance. Then it comes down and breaks our midpoint and accelerates. This is in a midpoint acceleration bar. So now we're going to go down and we may test yesterday's low, which is right here. And there was somebody waiting there too. So you had a little rally, came down and broke that. And we ultimately ended up basing or trying to base at the overlap. So these are things you want to do pre-opening based on what happened the prior day. Now, knowing what happened the prior day, it usually gives rise to a couple of strategies here, a couple, 3 or 4. And here's what they are. The first thing we do, of course, is we want to find out, well, what is our average expectation? It's quite big on the S&Ps, so we spot check a couple of bars. The width from high to low in this bar was 19 points. Here's a smaller one for 16. Here's a relatively bigger one, 27 points. Here's 20 points. There's a really big one, 39 points. Here's 4. So we see it's 14 or 15 to 20, or doubling that to 40. So I'm saying it's a range of 14 to 20 almost every day. So we would make a rough estimate every day of what the average size is. So this might be our average bar. And then we find out there's 5 possibilities, or basically 5. One is unchanged. And here's what they are. The next day could be an up day with an overlap to the center of the bar. It could be a down day with an overlap from the center of the bar. The market could be completely unchanged with the same range of yesterday. Or it could be a gap and run type of day. It doesn't overlap at all. It just opens up and really runs. Or it opens down and really runs big. So on the first 2, our strategy here is to try and trade near the midpoint overlap. If it gaps up and pulls back, we want to buy them. If it opens here immediately down on the day at the midpoint of yesterday, we want to buy them and look to sell them up here. Same thing over here. If they open at the midpoint and start down, we'll go short and cover at the gap. If they open down big below, we may want to buy it for a rally back towards that. On the gap and run, basically, if there's momentum on the tape, and we'll verify this by looking at the broad list of stocks, if there are some signs of momentum, as soon as we get here, we'll go long with a stop out at yesterday's close or yesterday's high. Because as soon as they overlap, we know we're wrong, and they're probably going to go all the way down to the midpoint, or maybe even reverse, and that high we bought was the high of the day. So these are breakaway moves that we're gambling on, and we're going to go with the trend with the overlap. Sometimes when you're in long extended moves like this daily move or intraday when there's very little